Chris is a really good guy. He started investing when he was a teenager, and now he manages investment portfolios. He's got a really big heart for education and helping people build their wealth throughout their life, and so that when you retire, you retire wealthy. And and it's pretty much like a discipline, and he's going to go over all of this for us, and he's just a pretty amazing guy. And so together, we all make a really good team, um, because what I do and what Andrianna does, you need your loans, for real estate. We've got the real estate, we've got the lender, and we've got your investment advisor.
All of them is a good investment, right?
Right. Yeah. So there he is. I've already introduced you, and we're ready to go.
All right. Cool. Well, good morning, everybody. This is a little different than the Zoom meetings I do with my kids' school, where you can see like 25 families together. I don't see anybody. I don't know if everybody knew that. I only see Jane and Andrianna. So if I scratch my head or do something weird, I apologize. It's because I can't see anybody. So anyhow, so good morning and welcome to our wealth building workshop, where we are going to talk about how with every crisis comes great opportunity. So our discussion, it's kind of broken up into two parts. First part, we always like to look at why we invest, kind of revisit some topics that are second nature to some people, but I think a lot of us forget that really drives why investing works, especially long-term investing. The second part would be more applying these things to the current climate. So as we all know, we're in a pandemic, and as it relates to investments, it's created actually lots of opportunities, if you ask us. So there's two parts. In between the two parts, we'll have a Q&A, little break if anybody wants to ask questions. I think throughout the presentation, there is, what is there, Jane? There's the Q&A section. You can type in questions, right?
Yes, that's on the bottom of your toolbar. To the right, there's a Q&A, and there's also a chat to the left in case you're not familiar with it. But yeah, go ahead and type in any questions you have in either one. It's fine.
Yeah. So, and we'll get to those either in between the two sections or at the end. So with that being said, let's get started. Oh, before I get started, I always have to do this. This little note from our compliance department. As you see, anything I say today really isn't meant to be individual advice. It's not an invitation to go buy a big giant house or go buy a particular stock or anything of that nature. This is more in a general sense today. It's all applicable, but I think you should always advise or always seek the advice of a professional, whether it's your real estate broker, your mortgage loan officer, or an investment advisor. You always should do that beforehand. So that is that. Compliance department will be happy. A little bit about us before we get started. Typically put a little biography of who we are and what our firm is all about. As you saw at the front, the name of the company is William Allan Investment Advisors. That's exactly what we are. We're investment advisors. Me personally and the firm, there's about 5 of us in our firm. We work with people primarily are planning for retirement, and we help manage their investments. But instead of putting our biography on the screen, I figured I'd just show you a chart of how long we've been around. We've been around for about 2 decades. The chart with the lines, that's the actual stock market. You see we've seen a lot through the years. We saw the dot-com bubble. We saw the recession, the first recession that was prompted by 9/11 bombings, Enron WorldCom bankruptcies, a second recession about 10 years ago, and obviously what we're going through today. And you'll notice that chart, while it goes up and down throughout the years, it goes to what we call the Northeast. So it continues to go up over the long term. So we've seen a lot, but from an investment standpoint, whether it's real estate, whether it's stock market, really whatever you're investing in, if you invest for the long term, obviously it keeps going up. So we've seen a lot, and we know we'll see a lot more, but we're happy that we've been tested. So that's a little bit about us. So let's get into the presentation. So when we talk about the wealth building playbook, the path to wealth, we always got to establish why we invest in the first place, right? We have tangible goal and we have intangible goals or intangibles to investing. The tangible goal is the same for pretty much everybody. On this chart, we said build enough wealth to create income for retirement. Everybody should be trying to build wealth. You should always be trying to grow your capital, whether it's, again, whatever asset you're using, you want them to grow for the sole purpose of and to beat inflation. You know, inflation runs about 3% a year, and you always want your money to grow faster than that, and that's how you build wealth. I think more importantly than the actual physical dollars that you create, that you grow, it's the intangibles that having wealth does for you. And these intangibles, I've laid out 4 of them here. I think your future financial freedom. Everybody is going to stop working at some point. And you want to have enough wealth to be able to be free to make the decisions you want to do. I mean, some people might work forever. I mean, I'll probably work until I can't work anymore, just because a lot of people will probably be upset if I stopped working. I have a colleague at another firm. He's 82. He's been in this business for 50 years, and he's still working. So he loves it. But other people want to be done and want to do something else. So by investing and creating some wealth, you'll have the freedom to do that. The second point is kind of the same. Enjoy the dignified retirement you deserve. And I think the biggest thing is, you know, creating wealth is empowering. It gives you not only freedom to do what you want to do, but it really gives you a peace of mind as you go through life. My personal background, I grew up, you know, one of 4 kids with very little, a single mom. And by now being an investor, investment advisor, obviously I practice what I preach, and knock on wood, I've managed to build some wealth, and it just gives you the peace of mind to be able to do what you want. And the last point is probably, might be the most important. It's kind of too easy not to, quite honestly. You know, I've got clients that I've been working with for 20 years. They still don't believe in some of the things I'm going to show you today, but you can't deny the actual facts of investing and growing your wealth. So the big piece of this whole thing that we call investing is what some consider the 8th wonder of the world. For those of you who might have participated in the presentation that we did a few months back, you heard me talk about this at length. And again, I'm going to talk about it at length today because it really is the crux of why we invest. It's called compounding interest. So like I said, I'm sure a lot of you are familiar with compounding interest, but we'll go over it again because it really is how people get wealthy, quite frankly. The definition in the dictionary is that right there. I won't read it. It's kind of boring. It's interest on interest. But the better definition comes from this man, Albert Einstein's take. He says, compounding interest is the most powerful force in the universe. And quite frankly, he probably is right. I'm not going to doubt Albert Einstein. I don't think anybody else is either. So let's look at it in practice. So the question there is, would you rather have $1 million today or a penny double every day for 30 days? Unless you've seen this before, most people are going to say, I want $1 million today. I probably would say that. But if you got a penny and you doubled it every day, so you went from 1 penny to 2 pennies, right, to 4, 8, 16, and onward and onward. I don't know, is that sharing this little message up there?
Oh.
Let me close this. Sorry.
Oh, I was just going to say, nice sound effects and animations.
I don't know if you guys are seeing that. Somebody texted me. So anyhow, so if you keep going and you keep doubling your money every day for 30 days, you'll see what happens. You end up with $5.3 million. Obviously, you're not going to find any investment anywhere that's going to double every single day, but it kind of gives you the idea behind compounding interest. You know, if to take it a step further, if you took $100 today, this is really how it works. You take $100 today or at the beginning of the year and say you invest it and you get a 10% return. At the end of the year, you'll have $110. So then when you go to that second year, you're not starting with $100, you're now starting with $110. And that grows, say, at 10% a year, or 10% again. And at the end of that year, you'll have $121, right? So it's the interest on that $10 from the first year that you gained in interest. It's interest on that. Obviously, the really key to this is that you want to keep your money invested for the long term. I had a client who came to me, inherited some money, and he was only with us for a few years because every year he would take his gains, right? He came in inheritance, like I said, I think he got like $500,000 and did well the first year. He just took all the gains. Then the next year, started the same number we started the first year. I was like, Mike, your money's never going to grow if you keep taking your gains. And that shows you the opposite end of what happens if you don't leave your money in and let it compound. So compounding interest really is the crux of any investing. You see it in your real estate. You see it just in buying your first house. By holding on to it and letting it grow over year, it compounds in value. This is a little different because you don't get to see the feedback of the people listening. So hopefully you guys are getting it. And if you don't, you can please ask questions and we can go through it. So we know from history that compounding interest works, that investing works. Over the past 25 years, your average annualized returns for real estate have been 9.4% a year. For stocks, a little bit more at 9.8% a year. So now if you apply that to a 25-year period where you started with $100,000, that's what your money would have grown to. Right over $1 million in the stock market, close to $1 million in real estate. Real estate, because of the tax benefits, probably takes a leap above stock market, but without including any kind of tax benefits here, that's what you see right there. And that's because of compound interest. Because you would look at, say, stocks and you say 9.8%, so let's say 10% to round it up. You would think if you invest $100,000, you know, just the 10% a year on that $100,000 for 25 years is only going to be, what, $250,000. But you start compounding, you have that extra money that comes in every year and keep that invested. This is what happens. I mean, it works. Definitely works. And then the great Warren Buffett once said, you know, someone's sitting in the shade today because someone else planted a tree a long time ago.
I love that quote.
It's a great quote, yeah. So that's kind of the premise behind why we invest, right? Take advantage of compounding interest. But really, to be successful at investing, you have to have certain traits, I would say. First, you have to have time, right? You got to be able to keep that money invested. That's why they always say the sooner you start investing, the better off you're going to be. That's not to say if you get started later, you're SOL. You're not. You can still invest at any time. You just got to keep your money invested for a period of time. Gosh, I read the other day that people that are being born today because of the advancements in medicine, some of those people live to they project to 150. That's crazy, you know? So it doesn't matter if you start a little bit later, you still have a long time for your money to compound. Right now, when we do financial plans for people, we project out that they're going to live into 90, 95-year-old range. So, but time is definitely important. The next factor is that obviously you have to contribute. You have to commit to investing to make investing work. Takes money to make money, right? And the third aspect that you need to have, you have to be willing to keep your money invested for the long term. You can't jump out of the market. In March and April, I don't know how many of you guys on here are investing through 401ks or just invest in the stock market and regular taxable accounts. But March was rough. I mean, 20-something days, the stock market dropped 35%. I mean, unheard of, right? Markets dropped that much before, but it's never dropped that fast. But you had to be committed. You got to stay invested. That's the worst thing to do would be to obviously sell at that point, because what happened? Right away, the market came straight back up. And if you sold at that bottom and then it starts going up, then you start thinking, oh, no, did I make a mistake? And then you don't know where to get back in. You might as well just keep your money invested for the long term. So it's really, in our opinion, like I said, I've been doing this for about 20 years now as a professional. Probably about 30 years. I've been an investor, 35 years. I've been an investor for a good period of my life. Contrary to my gray hair and bald head, I'm actually only 48, not 58, 68. But in our time, I would tell you 80% of what we do as far as planning and investing is math. You know, 10% would be the art of investing, how we invest. And the other 10% really comes from our clients and from individuals. It's your behavior. Your behavior is going to cause you to be, or it's going to cause whatever level of success you're going to see in investing. And here's a couple of charts to kind of prove the point of all those three aspects tied together. So here you go. The earlier you start investing, the easier it is to reach your goals. So if you start at age 25 and you invested $380 a year or $381 a month, you'd reach $1 million by age 65. This graphic forecasts that your money would grow at 7% a year. So a little bit less than the other graphic that showed that the market's up 9% plus over the last 25 years. So if your money grows at 7% a year, that's how much money you would need on a monthly basis, or to contribute on a monthly basis, to reach $1 million by age 65. So obviously, the sooner you start, the better. So that takes into account the time and the commitment of putting your money into investing. Now this shows what happens if you do get freaked out and you do take your money out of your investments. It shows what happens. So if you stay invested, this is over the past 70 years. If you just invest in the S&P 500 index, for those of you who are not familiar with that, that's just the index that includes the 500 largest companies that trade on the U.S. stock market. You would get nearly an 8% return over the past 70 years. Now, if you took money out and you missed the top 10 days of every year, your return now goes down to 6.7% a year. If you took your money out for the top 20 days of every year, you see where your return keeps going down, down, and down. This obviously demonstrates that you need to keep your money invested for the long term. Do not take it out. If anything, you want to put it back in. You know, I always tell people, or we talk to people, and I know, you know, because we're working, as far as myself, we work with people from all different walks of life, right? But the majority of people are what we would consider the middle market, affluent market of people. And if you ask most people, I would tell you 90% of them, if you ask them, do you know anybody who's wealthy, who's rich? And most people do. And if you ask them how they got there, if it's through investing, 9 out of 10 of them are going to tell you that the people they know did it through real estate. Obviously, because real estate's a good investment, as you saw the graphic before. But the underlying reason why we believe that is because you can't sell your real estate every second like you can stocks. You have to stay invested. You have to stay invested for the long term when you buy real estate. And because you're forced to stay invested for the long term, you ride out the ups and downs, and over time, your asset will grow in value. Here, this chart obviously is looking at the stock market. So if you get nervous and you sell out at certain times and you miss some of these top days, obviously it's going to impair your returns. Because I know a lot of people who look at the stock market and think you don't make money in the stock market, which is can be further from the truth. But this is why. So as we go forward, so we've covered the compounding interest is the core of investing. Kind of looked at some examples there, the traits we feel like everybody needs to have to be successful over the long term as investors. Now I want to show you what we feel. I mean, this is, like I said, this is kind of, everybody should look at things on an individual basis, but in a general sense, It's our belief that people can do these two things to get started, and you'd be well on your way to building wealth for the future. And it's step 1A and step 1B. Step 1A, you want to buy a house. Step 1B, you want to invest for retirement. I'm sure there might be some of you guys on this call here today that have already done these things, which is awesome. And I'm going to show you here in numbers why it's awesome. So step 1A, if you buy a house, the average house in Southern California, I looked up this week when I was putting this together, $440,000. So if you put 20% down, you have $88,000 of income or of equity in the house. There's your mortgage, there's your monthly payment. Quite frankly, that monthly payment is probably close to what it would cost to rent. So it makes sense to buy a house. So now if you look at the same house 10 years later, based on it growing at that 9% rate a year, you now have a whole nother block in this graphic. So not only has your mortgage gone down because you've paid it down, your home is appreciated, and therefore you see the value that has been created just over a 10-year period. Again, obviously we're just looking at averages. Maybe the next 10 years, the stock market or the housing market only grows by 5% a year, but it's still growing, right? And you're still paying into an asset. So this actually, I lowered the annual growth rate. So the annual growth rate for this period of 7.5%, if your house appreciated 7.5% a year, and you had a 3% rate loan, you've created $612,000 of equity. That's great. And then 1B, you want to invest for retirement, right? So again, this is an average number. Average salary of somebody working in Southern California is $65,000. So now if you're able to contribute, say 10% of your salary to a 401k plan, and you get a return of 8%, right? A little less than the 9.5% we looked at before. Always like to be a little conservative. Over a 10-year period, your account balance will be $112,000. Again, that includes your salary growing by about 3% a year. So in total, after a typical decade, this is what we call the basics, the basic building blocks, you have created $725,000 of equity. I mean, that's great. That's a great jumping off point. If you're just getting started, even if it doesn't matter what your age is, just if this is a start where you're at, great jumping off point to building wealth. If you've already done these two things, kudos to you. I mean, you see what value hopefully you've seen created through these two investments that you have made. The one caveat, which I didn't really talk about, was the tax benefits doing both of these. I'll tell you this, I say it all the time. When the government wants you to do something, so when the government says, basically is telling us, hey, Social Security is kind of underfunded. We don't know about your retirement benefits in the future. I mean, you always get Social Security, but the benefits probably go down. Or, hey, we want to see everybody buy a house. We want people to be homeowners. They give you tax breaks to do these things. So both these cases here, step 1A and step 1B, that's what they're doing. They want everybody to buy a house, so you get a mortgage interest deduction. They want everybody to invest for retirement, so they allow you stuff. I think now the number this year is $19,500 a year into a 401k plan before tax. Those tax numbers are huge. I didn't really put them in this presentation just because I know it's Saturday morning and everybody's at home, and if you got kids, I made it to my office, but if you got kids, I know they're pulling on you. You don't want to sit here for 3 hours talking about the tax breaks of these accounts. But if you've already started participating in these things, you've seen it. But the one thing I would say with the tax savings that you get, you may want to do something with that. You may want to invest it, and it will expand these two assets even more. So that's kind of the first half of the presentation. Like I said, I know a lot of these things, these concepts, people already understand, but hopefully I kind of paint in a different light. I think a lot of times, like I've said, even with clients I've had for 20 years, they've created a good amount of wealth and they're close to retirement. A gentleman who's turned 60 this year. He was going to retire, but with the market kind of collapsing, he got kind of worried that was going to be his source of income in retirement. So he wants to work another year. So this guy has been with me for 15 years, actually. And he still, I wouldn't say he doesn't believe in these concepts of investing, because this is just plain vanilla. This is math, but he's a little uncertain. So yeah, hopefully this kind of showed it to you in a different light, or kind of reiterated some of the stuff you already know, and even in these times, it still works. So, are there any
If
questions?
anyone has any questions, you can type them in the chat box. I'm still kind of new at the tech stuff, so I'm not sure that I can have people unmute or anything. I'm not sure how to do that. So if you have any questions, please put them there, or otherwise Marcus will continue the presentation.
Cool.
Oh, there's one.
All right.
It says,
It was actually mine. I just thought it might be helpful to say, I know you didn't want to get into the tax breaks, but I think that there's like a cap or a max tax break you can get if you invest in a 401k or IRA. Like the 401k is significant, wasn't it? Isn't it like 16 or 18,000?
Oh yeah, yeah. So if you work for an employer that offers a 401k plan, you obviously want to take advantage of that because the limits are much higher. So Andrianna's saying. So this year the limits, I think 2020 is 19,500 for anybody under 50. Once you turn 50, they give you what's called the what they term it, but they allow you to put more in. So you can put another 6,500 in. So you can actually put 26,000 in if you're over the age of 50. If you're under the age of 50, 19,500. So kind of to do the math on that, let's round that 19.5 up to 20,000 just for a round number. If you were able to put $20,000 into that account, let's say you're in the 20% tax bracket, you've just saved yourself $4,000 in taxes. I think from an investment standpoint, as we're kind of stay on topic here, you probably want to do something with that $4,000. Whether it's investing in a regular taxable account, or if it allows you to buy a bigger house or go out to buy another house, whatever the case might be, you want to do something with it. Now, on the flip side, yeah, if your employer does not offer a 401k plan or a 403b if you work for a nonprofit, then you're kind of stuck with the IRA account. The IRA limits are a lot less. The IRA limit, I think, is 6,500 this year, or 6,000 if you're under 50. And I think they add another 1,500. So it's way less than if you participate in a 401k. But
and then is the IRA something that we do if we wanted to? It would be something done with you because it's not done like an investment that you do through your employer, correct?
Exactly, yeah. So if you wanted to do an IRA, of course, I'm more than happy to just put it out there. Anyone on this call, if you want to follow up and just want to talk about some of this stuff, I'm more than happy to talk with you. We can Zoom if you want to Zoom. We can have a conversation to talk about any of the stuff we're talking about today. And as Andrianna was saying, yeah, so if you want to open an IRA account, you need to do it at your own financial institution. So for us, our firm, we work with TD Ameritrade. So TD Ameritrade is where you would open an IRA account. If you're going to go off, do it on your own. Any of your banks would do it, but like Charles Schwab, Fidelity, all the brokerages would be able to do that for you. Yeah. So.
And then I see another question, Jane.
Yeah, it says rental income properties benefits now. I'm not sure I understand. But that's definitely part of your portfolio is also having stocks and having the different properties that provide income to you as well. If there's something specific about that question, please
ask.
yeah. If you could be more specific, I would be happy to answer that. But yeah.
Okay.
I guess we can go on.
All right. So Sal, as the title of the presentation says, with every crisis comes a great opportunity. Again, our friend Albert Einstein said, in the midst of every crisis lies great opportunity. And, I've heard it said over a lot of different ways over the past few months. I was meeting with a client the other day who helps run a nonprofit, and instead of shutting their doors, they they seized this pandemic time as an opportunity, and they really got busy, and he's actually grown his organization during this time. But for us here, as far as it relates to investing, you know, the historic opportunity that we see here today, it begins with historic low interest rates. I pulled this up. This was as of last month, 7/23. I don't know if they're still that low, Andrianna, but I know 3% was kind of the range for the 30-year fixed loan.
Yeah, I mean, they were trending even a little bit lower than that as well. So they're amazingly low.
So that is, I mean, it's really unreal, to be honest with you. And if to put that into context, here's the 30-year rate over the past, well, what's it, almost 40 years. And so you see where we're at way at the right. You put 2020 out there on the end there, and it's even a little bit lower. But we've been in what's called a, well, you can see it from since 1981. So about a 30-year, what's called a 30-year bull market for interest rates, because interest rates are going down. I mean, I'd be honest with you, as an advisor, I thought a couple of years ago we reached the bottom, but obviously I didn't foresee a pandemic and all this money being unleashed on the economy. So we've gone even lower. And what this means for all of us here, if we're homeowners already, or if we're not homeowners, there's a lot of opportunity to, there's the basis of the opportunity is that you're getting money at a super cheap cost. To kind of go over some of the opportunities that we see, and I'll kind of share my own personal situation, what I'm doing, and kind of put this even more context to just give you more clarity, and I don't want to say belief, but just understanding of where we're at. Because a lot of people say, gosh, we're in a pandemic, it's a crisis, we got to hunker down. And really, from this instance, it could be further from the truth to think like that. I mean, if you're working, your job's secure, you have the ability to make payments like this, there's no reason why you shouldn't really seize the opportunity here. So the first one is, you know, obviously refinance your existing mortgage. Needless to say, that's going to lower your monthly payment. If you refinance and held that loan through its duration, obviously it's going to decrease the amount of overall interest you pay, and it's going to free up some monthly cash flow that you can invest in, say, your 401k or your, thing is, hold on, let me close this thing. Quit. All right. Free up monthly cash to invest in your 401k or your IRA. The second opportunity would be refinance and do a cash out, right? So same idea would be maybe to maintain your current monthly payment, access a good sum of cash, and then be able to invest that cash somewhere else, whether it's in an investment account or into another property. One of my brothers just did this. He's not the one I run this business with, but the guy who runs another business for us. He's got a moderate house. I think is paying his first time he refinanced, and I think he had a $400,000 mortgage. But his home is appreciated in value, and he took out $100,000 to invest. His payment, I think, is very similar to what it was before he refinanced, because I think he was going from a 4% plus down to like a 3% loan. So why not, right? He got all his money at 3%. So now not only does he maintain his property, but now he's got $100,000 that he took and he went and invested. He invested obviously with us. So that's the second opportunity. Then needless to say, the third opportunity would be obviously buy your first home. So if you don't own a home at this point, you need to take advantage of these historical low rates and buy a house, quite simply. Then you start taking advantage of the mortgage interest tax deduction. And I know in some people's mind, they say, well, home prices are at a peak. I don't know if they're at a peak. Are they close to a peak? They're up there, right? Home prices these days, they keep going up.
They're definitely
right?
there.
So, but the home prices, and they're a function of interest rates, lower interest rates. It's all about the cost of what's it cost to live in that house? What's the payments, the monthly payments? But I'll tell you from my perspective, I'm not in real estate. Jane and Andrianna obviously know a lot more about the real estate market than I do. But I can tell you every single person that's come through my door and they see me as an investment advisor and they ask me about what I think about real estate. And they say, what do you think? Should I buy this house? And I say the same thing to every single person. I mean, I have a sense about interest rates and whatnot, but I say the same thing to every single person. First of all, could you afford the house? Yes. Second of all, do you plan on living there for at least 10 years? Yes. Then go buy your house, right? Because over that period of time, it goes back to what we were talking about before, long-term investing. You're going to be in it for the long term. What's the difference? And there's so many benefits into buying a house, especially your first house, from the mortgage interest deduction to the fact you're building equity versus paying rent. Who cares if we're at the peak of a housing market? It doesn't matter. The affordability is what you're after, and you want a house. Sure enough, the last person I told that to came back to me. They're not even a client, but they came back. They wanted some more advice on something else, and I should like the best decision we ever made. We want to thank you for that. Best decision we ever made. I'm like, well, you're welcome. Yeah, go ahead, Andrea.
Can I interject too? Also, no matter what time when you buy your home, you end up paying less for the home, even if we're at peak in the market, because the interest rates are so low. If you bought a house and maybe it was $20,000, $30,000 cheaper last year, overall you're gonna pay less because interest rates are so much lower. When you're thinking about paying interest on hundreds of thousands of dollars over 30 years, you end up paying less.
Absolutely. Yeah. So, yeah. So
to interject too, while we're talking about mortgages, that's kind of like your own rent control, because your mortgage rate is your mortgage rate, for those 10 years. You're not renting and having your rent increase on a yearly basis. So it's just something to keep in mind as well.
True.
And I'll get back to the refinance part. So, the lower rates they don't have to drop as much for it to make it worthwhile to refinance, right? So we went back. So if we go back to this chart here. So my wife and I bought our first house in 1999. So you see interest rates were at 8%, right? So when 8%, the time that we owned that house, rates went from 8%, they went all the way down to like 4%. We owned it all the way through 2009. So obviously going from 8 to 4, essentially rates were cut in half, from 8% down to 4%. Well, now we're looking at rates from 4% down to 3%. That 1%, that's a big impact, right? So you can look at it, because I think you used to say the rule of thumb was rates had to drop by X percent to make it worthwhile to refinance. I think it was like 1% maybe. I don't know, Andrianna, is that right? I forgot what number it was.
Yeah, and I usually run an amortization schedule for clients. Like, this is your monthly savings, and this is what you'll save over the life of your loan. Yeah. And it's up to you if you feel like that's worth it then.
Yeah.
Yeah.
So those are kind of the three obvious scenarios that you can do with these low interest rates. My personal situation, this is where I'm at today. I haven't done anything yet. But so my existing rate is 3.75. Obviously, current rates are around 3%. On my loan, without getting into dollar amounts, that'd be about a monthly savings of $500. So I'm gonna save $6,000 a year by doing this. My options, obviously, take that money and invest it. That money would grow to about $92,000 over a 10-year period. Or I can use it to go buy a vacation rental home, which is something we probably will do because, as an investment advisor, I've been investing in stocks for a long time, and we do preach you want to have a diversified portfolio of investments, so you can have your stock portfolio, 401k account over here, and then over here you can have you obviously have your primary residence. Then you get out and buy some rental property, or a vacation home. For me, it'd probably be more of a vacation home. But again, just building assets. And whichever way I go, I know I'm pretty certain that over 10, 20 years from now, I'll be better off than not refinancing and just sitting and paying my mortgage for the next 10 years. So why am I so certain?
Why are you so certain?
Why am I so certain? Thank you. Right here. So the crux of this opportunity is your cost of capital is so low, right? It's 3% or lower. And your expected return on this investment is 9%. So right there is what we call value added, the difference between the two, 6%. And the reason why I'm so certain is whether, even if housing valuations or the stock market or whatever you decide to invest your money in only grows at say 4%, that's still better than 3%. Even if it grows at 5%, it's still better than 3%, right? You have such a huge opportunity here because you're getting money on the cheap, historically cheap. I mean, Jane and Andrianna might invite me back next year, do this again, and rates might be at 2%. I don't know, but I can tell you 3% is as low as they've ever been. So why not take advantage if you can take advantage? Don't look at this and say, hey, we're in a pandemic. And I mean, everybody's situation is different. So if you're in a situation where, like I said, your job is secure and you have a ton of or a good amount of equity in your home, which we all do. We've talked about how home prices have gone up. So if you've owned something for at least a few years, then it's gone up. I mean, if you just bought your house a couple of years ago, might be an opportunity to refinance and just lower your payments. But there is definitely an opportunity to cash in on this cheap money. And I'll tell you just one more example. If you do stuff like this, or you want to take advantage of this, you know, you're in good company. And the good company is some of the biggest companies in the world. So for instance, I saw the other day, we all know who Google is. Google, company that basically prints money. They make so much money. They got billions and billions of dollars of cash coming in every year. They went out and issued a bond. We're not going to go get into bond talk, but they issued a bond. So basically they went out and borrowed money, a 40-year term, right? Housing loans are on 30-year terms, but a 40-year term. And they went out and they raised like $20 billion. Do they need the $20 billion? Not really. But the interest rate is like 1.5%. So they went and did it. And they're not alone. A lot of big companies have done it. There's so much money out there amongst the corporate America. It's crazy. But it's kind of apply the same thing to your own household. If you treat your household as a business and all of a sudden you're offered these super low interest rates against your assets, right? I mean, I never preach over leverage yourself. You know, you don't want to have $1 million of debt if you only own assets worth $1 million. Obviously, that's a bad idea. But the fact that you most likely have equity in your homes, there's an opportunity here to refinance and capitalize on that equity and use it somewhere else. Whether it's, like I said, investment portfolio, more real estate, sell your house, buy a new house, whatever the case might be. There's huge opportunity there. So at the end of it all, we can talk till we're blue in the face about how the opportunity is there for you. And like I said, over long term, these things typically work themselves out. Things go up and down, but over time they go up. But the key is really yourself. I mean, you really have to demonstrate the behaviors that we discussed at the outset, which is obviously you got to allow time for these investments to work. You got to be committed to them, and you got to be in it for the long term. So you got to not, if it's investments in like the stock market where money is more like liquid, you can't be buying and selling every day. You got to stay committed to what you're investing in. That's it.
Okay, so there was a question saying because of the market and landlord abilities to collect rent now, given the current crisis situation, should we wait to invest? And I think that kind of touches on one of your last statements about it. You know, it's really about your individual portfolios. Like, are you over leveraged? Are you not over leveraged? What is your investment strategy? What's in your portfolio? I think it really becomes an assessment of that, because some people buy the income properties just for cash flow purposes, because there are markets where, you know, you can afford to get a duplex or a fourplex, but it's affordable but it's not going to appreciate very much in that market, but it cash flows. So, that's one strategy. And then there's others, like if you buy out here, you're not only looking for cash flow, but you're also taking into account the appreciation over time. Like we were talking about the time being one very important aspect of investing. So, like you were talking about, as long as you don't over leverage yourself and that you do have the reserves and the ability to cover for, if there aren't any rental payments coming in over time, you'll be okay. But I think it's really contingent upon the assets that you currently have and the investments that you make in your individual portfolios. And Marcus, if you wanted to chime in on that.
Yeah. No, absolutely. Absolutely. I mean, the idea is that where we're at today with these low interest rates is that if you can lock in at this low interest rate of 3% or wherever the number is, whatever you end up getting. Yeah. If you look at it and you view it over a 10-year period or a 20-year period, I mean, you're locked in at that rate. Interest rates are going to go up throughout the years at some point. I mean, you would think it's going to happen at some point. Interest rates will go up. So yeah, so the idea is, hey, let's take advantage of the money, the cheap money today. And it's, as you just said, Jane, I mean, it's, as we said through the presentation, it's all individual. It's where's the opportunity for you and can you withstand the current environment? I mean, it's really, let's take advantage of this money. I mean, you can get the money today and you don't have to go out and run out and buy a rental property tomorrow. If you feel you need to wait a little bit, then you wait a little bit. But if you do have the assets and you find property that you can buy and hey, maybe you have to withstand 6 months of no rents or whatever the rent abatement programs are. Like I said, I'm not a quote unquote real estate person, so I don't know where everything stands today. But if you can kind of get through that for the next year, next 2 years, whatever the case might be, or next 6 months, look at the long term. Again, I mean, it starts with, hey, I was able to borrow at such a low rate and I was able to get my hands on this equity, this capital over a long period of time. Things do revert to the mean per se, and the mean is, those returns of 9%, 7%, and like I said, real estate has a lot more benefits to it that go beyond just that return because of tax breaks and whatnot. So I totally agree. Yeah, it's definitely then you just got to look at it look at what's happening today. And I mean, like I said, the money's so cheap. If you can find a way to put it to use, it's everybody's individual situation, but I think you can find a way to put it to use. I mean, if you just refinanced and took the money out and invested in the stock market, maybe the next year or two, the stock market goes sideways, maybe it goes down, but over a 10-year period, it's going to go up. Same idea. You pull money out, you go buy another piece of property. I understand the rental income aspect of it, but I would think over time, as you're saying, Jane,
Yeah.
if you can handle the short term, you'd be fine.
Yeah. We also have a couple Q&A questions. Did you see those, Jane?
Yeah. You want to take turns? You read the first one and then I'll do the second one.
Well, the second one would probably pertain to me a little bit more. The first one, maybe you.
Okay.
Okay.
All right. I'll go to the top one. If I have made a major gain about $1 million in my home, wow, congratulations.
Yeah.
And my home value as it's almost paid off, I was looking to sell my home with the gain, but then was thinking about renting it out for a very good amount. So should I sell? I was looking at buying a couple other houses instead, or should I borrow money against my current house since rates are so low to borrow and buy some other property to rent? Wow. That's a very good problem to have.
If it's a problem.
I mean, there's plenty of people that would love to trade places with you. That's a really good question. As far as the financing, Andrianna, would you like to speak to that?
Well, I mean, my understanding, and it's going to depend on the person, but I think it kind of goes along the lines with Marcus. Like sometimes it's good to hold and refinance and use funds from that property to then purchase your next one. And then you still have this property that can gain in value. But it,
And
you know, it
cash
also
flow. Yeah.
cash flow. It depends on your situation too. Does a house maybe need a lot of work and you would rather sell and buy a couple of other properties? Rates are really low to do a cash out refinance, so you could take the funds out to buy another property.
Can I chime in?
Yeah,
Yeah, I agree with that. I would say, I would not let go of the asset that you already own. I mean, you know that asset, you might as well keep it, but I would finance against it. You know, I've always said, you know, everybody's different. So this what makes this world go round, what makes actually investing interesting. Because like I said, a lot of it's math, but a lot of it's investor behavior. But in my opinion, I never see the reasoning to own a piece of property outright. I mean, it's an asset there that you can leverage. Again, not leverage abusively. But if you own something that's pretty much paid off, yeah, why not? Especially with these low interest rates, why not leverage it up and say whatever, borrow? You said it's worth $1 million. Say you borrow 200,000, right? At 3%, what's that going to be? $600-700 a month in payment. You're going to have a renter on that house, which is going to cover that, and then you can take that $200,000, and if you have opportunity to invest it in other properties that are going to yield the same returns that you're looking at, why wouldn't you do that? That's how you build wealth. You're capitalizing on the capital you already have invested. Obviously, you have to look at the specific situation and run the numbers against those other opportunities, as well as the income you're going to have on that current property. But I mean, absolutely. I mean, the opposite is what you stay. I mean, if you sell the house, you're probably going to end up with some tax liability on that house, especially at $1 million. I mean, if it's your first home sale, you're still going to go way over the exclusion.
Right.
Right.
Which is, we can speak to that. The first $250,000 per person. So if you're married, that $250,000 per person. So that would be but that'd be 500,000. So like if you were to sell it, that first 500,000, the IRS would not tax you on that first 500,000, but the other remaining equity they would. So that's also something to know.
Yeah. So I mean, if you wanted to like put numbers to it really quick, so if you had $1 million house and say you went and rented it for whatever, $3,000 a month, right? Versus, and just did that. So you're just sitting there with that asset of $1 million and you rent it, you got $3,000 a month comes into you, there's your $3,000 a month. Now, let's say you go borrow, say 200,000 against it, and you go buy another piece of property that the rental income versus the $600 a month you're going to be paying in mortgage on that 200,000. Now you just increase your income at a very low cost. I mean, net, we don't have to go through all the numbers right here, but net, you're going to be better off than if you just held the one property. I mean, you're kind of, the long story short, if you look at it and you're just sitting on $1 million asset and it's not doing anything except appreciating itself. That's the beauty of real estate. You know, I always say, you go into a bank and they're going to loan you whatever amount of money for 30 years because you own this piece of property. You can't go into the stock market and get the same type of loan. It just doesn't happen. And now with the rates so low, you really have an opportunity to expand your real estate empire per se at a very low cost. I mean, I would definitely agree with Andrianna from the outset that you would holding that asset because you know that asset and then borrowing against it, I think it's the best way to go. But as far as the particulars, you obviously, like I said, you'd have to sit and look at it yourself or work with somebody to make sure the numbers work out for you. But 99% sure they would. I mean,
Because you're essentially putting your money to work for you, and there's the opportunity to put it to work harder for you with the interest rates being so low.
Yeah.
All right. Then we had another question. It says, I have a mortgage at 3.5%. I've paid for 7 years and made additional principal payments to reduce the loan amount, but still owe $250,000 and plan to pay it off in the next 7 to 8 years. If rates go down to 2.5 range again, shall I refinance? I am concerned about the fees of the refinance. I don't want to redo a 30-year and not lock myself into a 15. That's why I am reluctant in refinancing. So this is kind of what I was mentioning earlier, where we would run an amortization schedule for you, but you don't have to do a 15-year loan. You don't have to do a 30-year loan. You could do a 21-year, just where you're at right now. If your original loan was 30, you've paid 7, you can do a 21-year, you can do 20, we can do odd terms. And then what I like to do is you take your monthly savings, and the average cost to refi is $4,000 to $5,000, and you divide that. And so let's say it takes 1 or 2 years to pay for the refi, then the rest of the term that you have that loan, you are, it's savings. And in your case, you have 7 to 8 years that you plan to continue to pay it. So if it were a 2-year payoff, you would have, 5 years, 6 years of savings on that money to refinance. So I hope that answers your question. And we could look at your situation personally. If you want to message Jane or have her contact information, she can forward my contact information to you.
Type it in here, too.
Oh, okay, perfect. And then and I can run your exact situation for you, and then you can decide for yourself. And I'll type the information now.
Yeah.
Does anyone else have any other questions for us?
No, I don't see any other questions. Okay, I just put my contact information in the chat box, so if anyone needs that, then I'll give Andrianna a chance to do the same. Marcus, I think you, well, you know what, we'll just email everybody with our contact information. How about that?
Yeah, we can do that as well.
Yeah, because everyone's portfolio is different. We all have different assets or want to get started on building a portfolio. So putting our 3 heads together and coming up with a strategy is a really powerful thing to have your team all in one place. I want to thank Marcus for your fabulous presentation, and I feel like these type of presentations like bear repetition, at least once a year to just like keep you on track, or more than that, actually a couple times a year. Yeah. Thank you, Andrianna, also for co-hosting and lending your expertise in the lending world. I just wanted to also say right now with the real estate market, some people have the perception that the market right now is shot, but it's actually really hot, and prices have increased, especially at the entry level price point of like 500,000. I mean, I am selling houses that I sold like 2 months ago, literally 2 months ago, that if I were to put the same house on the market today, it would be like $30,000-$40,000 more in just 2 months, because it's that competitive. And we've always had the limited inventory, but now there's almost like a shortage of inventory. So it has increased the value, just because there's just not much to choose from, and we have more buyers, way more buyers than we have inventory to sell. So that's just something to know as well. Thank you everyone for joining, and we'll be in touch.